say that. I'm going to say that again because I almost forgot to turn on the recorder, which is real new since I've done it before. My name's Don Vivrette. This is Financial and Estate Literacy. This is It's Your Estate, and it is week 4, and we're going to talk about retirement planning. And Michael, you're here, and I'm going to disappear. People have Q&A questions for us. I will answer as I said. And if not, I will see you guys later. Take care.
All right. Thank you, Don. Hey, welcome, Michael.
Glad to be here.
Good. This is Financial and Estate Literacy. Since we just started recording, Michael is our presenter today, and the topic is going to be retirement planning. And he's going to tell you a little bit about why this is so important. And Michael is one of our best presenters. Let's go to your Ask First form. We're not going to go through it thoroughly, but we are going to hit some highlights of this. And how long have you been an estate planning attorney, Michael?
So I've been an estate planning attorney for over 20 years.
And have you been focused in on estate planning, or do you do other areas, family planning, business planning, litigation, etc.?
No, my focus is estate planning, and about half the time I spend helping families and individuals design their estate plans, and the other half the time helping people administer trusts and their estates after the clients have passed away.
So if you're looking for an estate planning attorney, that's exactly what you want to hear. You don't want to hear that they're involved in other areas, because just the estate planning area alone is complicated. Yeah, right. It's not easy. And by the way, the topic that we're going to hear today, most attorneys don't have a clue about, because and Michael will explain why in just a little bit. But let's go into how do you charge your clients?
Sure. So we charge our clients in 2 different ways. The first way is a flat fee or a fixed price program for our estate planning clients. And the other way we do it is by the hour. But let me explain. So for our flat fee pricing, what we do is we have our clients or in a situation where our clients are doing what we call a standard estate plan without special complexity. And in that case, we can figure out a fixed price for what their estate planning is going to be. Now, we try to pack a lot of extra value that not every other law firm packs into their fixed fee pricing, and I wanted to briefly go through that. And so, of course, we do your will, your trust, your power of attorney, and your healthcare directives for you. But included in our flat fee pricing is also doing a deed for your primary residence. And included, again, in this pricing is preparing the deed, the property tax forms, recording your deed for you, and all those kinds of things. It takes a little bit longer, but again, we end up with a better result. The other thing that we help you out with, which is one of the main topics for today, is helping you with your beneficiary designation forms for retirement accounts. And I'm going to explain all that. But unlike a lot of other firms, we have our clients bring their blank beneficiary designation forms in with them and help them complete them. I think after today, you'll see how important that is. But that's something, again, takes extra time, but we get a better result by helping our clients with that. And in addition to that, we like to spend a little extra time with our clients, even in our flat fee pricing, because we want to make sure we have a good result. I usually spend an hour or 2 with our clients designing their estate plan at the beginning. And back at the end, instead of just mailing your forms to you or your estate planning documents and hoping you sign them correctly, I have you come back. I personally supervise the signing of your estate planning, make sure everything's initialed and notarized and witnessed in the right place. Again, takes a little bit longer, but we don't want these documents to be signed incorrectly and not be useful when you finally need them. So with all that said, we try to, again, put a lot of value into our flat fee pricing. Now, for a standard plan for a single individual, it's probably about $2,500 to $2,900. A married couple is about $2,900 to about $3,400. And lastly, if we have a very complex situation, a blended family, we're disinheriting a child, we're doing extensive estate tax planning, in those cases, we are not able to do flat fee pricing because we don't know how long it's going to take, and we charge $425 an hour for me. Paralegal is $175 an hour, but we do those and reserve that for our special cases.
And then you usually, I believe, give somebody kind of an estimate as to how many hours it will take you to do the proper research and the drafting.
That's right. And also, I'm also happy to offer anyone, if they're interested, a 30-minute complimentary consultation. I can sit down, look at your situation and give you an idea of what it will take to get your estate in order.
Yeah. And do you do these in person or do you do them by Zoom?
We'll do them any way that the client wants. I'm happy to do them over Zoom, but clients are also welcome to come to our conference room and meet in person. Either way works.
And you're in Newport Beach on Quail Street, and just all they need to do is give you a call.
That's
Do they
right.
have
I'm
to
right here.
say that they heard about you at the workshop, or is this just your general practice?
It's my general practice.
Okay, wonderful. If anybody has a question on how he charges, let me ask you, do you charge during this period of time for phone calls and emails? Are those extra?
Well, if we're doing a flat fee program, then it's a fixed price.
Yeah.
And even after we're done with our flat fee, if I don't know, you're having just a 5-minute follow-up question, I'm not a stickler on that kind of stuff. And
Okay.
I think I'm happy to provide the follow-up.
By the way, some attorneys are sticklers, so ask that question beforehand. You don't want to wait until the end. Okay, Michael, let's get into the program. There are so many changes in this area of the law, and let's get going.
Okay, sounds good. All right. So first, I want to say I'm excited to be here. I've got a great presentation for you, packed with a lot of really useful information. I think everyone's going to get something out of the presentation today. I'm happy to be here. And more importantly, I'm happy that you're here, because with a title like Retirement Account Planning, Pete and I are always wondering if anyone will ever show up for this presentation. But the truth is this is really important. And as Pete just mentioned, a lot of really important changes have happened over the last few years, some in just the last few months. So you're here at a good time. Now, I got my PowerPoint presentation up. That is downloadable on the It's Your Money, It's Your Estate website. So you're welcome to download a copy of it. As far as questions, as Don mentioned, he's going to field some, and you're also welcome to have them directed towards me. And I know attorneys aren't supposed to say this, and maybe you've never heard an attorney say this before, but I will answer all your questions, and I promise not to send you a bill.
Yay!
So let's talk about what we're going to learn today. So we are going to learn the latest rules regarding retirement accounts. And that's important because we've had, as many of you know, something called the Secure Act that was enacted at the end of 2019. We had 275 pages of regulations on how we're supposed to enact the Secure Act in 2022. And just a few months ago, we had Secure Act 2.0. So I've got all this built in today's presentation, so you're going to be up to the minute on what the current rules for retirement accounts are. Another thing we're going to learn today is how to calculate your required minimum distribution. This is called an RMD. And if you don't know what an RMD is, perfect, you're in the right spot, because I'm going to explain it to you today. A couple other things we're going to cover today. We're going to talk about choosing beneficiaries for this retirement account and how that works. We're also going to talk about whether the stretch is dead or alive. And again, if you don't know if the stretch is dead or alive, you're in the right place. And lastly, I'm going to finish with talking about Roth IRAs, which are sort of a completely separate animal in itself. And I've left that for the last part of our presentation. Now, let's start by kind of talking about what are we talking about? And when I say retirement accounts, I'm talking about your IRAs. Maybe it's a SEP IRA, a rollover IRA, a simple IRA. Maybe it's your 401k plan, 403b, Keogh's pension plans. All those things are retirement accounts and retirement plans. As I mentioned, the first set of rules I'll be going over aren't applicable to Roth IRAs. And again, I'll save that to the end. Now, why do we care about these retirement accounts? Whoops. We care about them because we get to make contributions and we get an immediate break when we put money into these accounts. So for example, if you make $50,000 a year working at a job and you put $5,000 to an IRA, we get an immediate tax benefit because we don't have to pay tax on the $5,000 and we only have a $45,000 worth of income. So we get this immediate tax break. And as you'll see through my presentation, I'm going to build in the new rules as they're applicable. And our first new rule under the Secure Act is that there used to be a limitation on when you could contribute to IRA accounts. And that limitation had to do with how old you were. Well, that age limitation has now been eliminated, and you can continue as long as you have earned income to contribute to an IRA account. So that's good news. Now, the other reason we care about these retirement accounts is that the contributions, the money you put into those accounts, get to grow tax deferred. And what that means is that there is no income tax or capital gains tax payable every year. So all the money stays in the account, and we get this potential amazing compounding effect that we can't get in non-tax deferred accounts. So with all that said, Pete, I know you don't know the number yet, but any idea how much might be in these retirement accounts in this tax deferred state?
I'm going to take a rough guess, 2 billion.
All right, are you ready?
I'm ready.
$34 trillion as of the end of 2022, and that is up $16 trillion since 2010. So an amazing amount of money is all sitting inside these accounts.
I can't even imagine. I can't imagine 1 trillion, much less 34 trillion.
Now, I guess my question to all of you participating today is, do you think Uncle Sam wants a piece of this action of this $34 trillion? And I want to remind everybody, all the money that's in these accounts is what we call pre-tax dollars. Your contributions, as well as the growth of these accounts, has yet to be taxed. So does the IRS want a portion? And I hope all of you out there are shaking your head, yes.
Yes.
And then the question is, what happens when you pass away? Do you think that the IRS still wants to get their share? And you probably should be shaking your head again. And the answer is yes. In fact, as we'll talk about in a few minutes, the Secure Act, which is this new legislation affecting these retirement accounts, the IRS has accelerated how they're going to get this money on a faster basis. And this last point on this slide, this is not tax-free money. It is only tax-deferred money. And in most cases, the IRS is going to get their share. Some people say that there's a mortgage by the IRS on these retirement accounts. And although there are some exceptions, which we'll go over, in most cases, the IRS is going to collect on that mortgage. Now, the last point I want to make before we sort of get into the substantive material here is that this is a really important part of estate planning. And sometimes retirement accounts can be our clients' largest assets. I have many clients who have more in their retirement accounts than they do in the value of their home. But in the estate planning process, many times this is overlooked. Clients and estate planning attorneys get focused on doing their will, trust, power of attorney, and healthcare directives, and they forget about these retirement accounts. And as you'll see in a few minutes, they do need special attention. So my point on this slide is make sure that when you're doing your estate planning, you take care of the foundational documents, but don't forget what I call the fifth pillar, and that is doing these beneficiary designations for retirement accounts. And again, we'll talk about that in detail in a few minutes. So the first part of my presentation is discussing these retirement accounts. And again, we're talking about your IRAs and 401ks and 457 plans, et cetera, and how these accounts are treated during life. So unless there's an exception, if you are under the age of 59 and a half, there's something we call the early withdrawal penalty. And this early withdrawal penalty says that if you take money out of these retirement accounts without an exception, that there is a 10% federal penalty and a 2.5% state penalty here in California. But remember, this is in addition to normal income tax because the money has not been taxed yet. So, for example, if you take out some money and maybe you're in the 30% federal tax bracket, maybe California's 10%, then we add the 12.5% on top of that. So this can be expensive to do early withdrawals. If you do an early withdrawal, then you get a 1099-R from the place that holds your retirement account, and you record that information onto your tax return so that you can pay the applicable taxes and penalties. Now, Secure 2.0, which is the second version of Secure, really an addition, and there are some new interesting rules. I noted one here that they have added some exceptions to this 10% or 12.5% penalty. And those exceptions, there are many, but including a special exemption from the penalty if you're a victim of domestic violence. If you're terminally ill, there's an exception, and some exceptions for taking money out early if you're in a long-term care situation. So some interesting exceptions to be looked at if we get into that situation, if we're withdrawing money before 59.5. Now, after 59.5, but before the age of 73, and that is not a typographical error, it is not 7.5 or 72, and we'll talk about that in just a second. You may, it's an option, withdraw money from your retirement account. Because we're over 59.5, there is no additional penalty, right? We don't have to worry about that 12.5% penalty anymore. But remember, it is still subject to income tax because, again, no tax has been paid on it. You get a 1099-R and report it on your tax return. Now, where it starts to get interesting is starting at the age of 73, and again, not 7.5 or 72, the IRS requires you to withdraw or distribute money from your retirement account each year. And the new rule under the Secure Act 2.0, which is just a few months old, is that starting this year, they are now changing the required beginning date, or the date you need to start making withdrawals from your retirement account, to age 73, which is great news. As many of you recall, it used to be 7.5, and then for about a year or two, it was 72. It is now 73, and eventually increasing over the next decade or so to the age of 75. Now, so for the next few years, we just have to worry about the 73-year-old age bracket. If you turn 73 in the next few years, then your beginning date is the year you turn 73. Now, this whole area of the law where we're required to withdraw from our retirement accounts is sometimes referred as an RMD, again, a required minimum distribution. And because we're over 59.5, we have no penalties, but the withdrawals that come out are still subject to income tax. And for everyone to basically understand what's going on here and why we are being asked to do a required distribution, and it's just that the IRS has simply said, we've let you defer the income tax on the money in these retirement accounts long enough. And starting at the age 73, the IRS is simply saying it's our turn. We're going to force you to take a little bit of money out of these accounts each year so that we can get our money. That is, so the IRS can take a share. And that's all this is about. Our required minimum distributions is a process for the IRS to collect taxes. So let's talk about this required beginning date. So with limited exceptions, as I've mentioned, you must start taking the required minimum distributions starting in the year that you turn age 73. And in most years, you have to take this minimum distribution out of your account before December 31st of each year. But there is a special rule we call the first year rule. And the law provides that you can delay your first year distribution, again, the year you turn 73, until April 1st of the following year. But watch out, because this can be a little bit of a tax trap for many of our clients. And let me explain how this works. If you turn 73, let's say this year, and you decide to take advantage of this rule, that means that you could delay all the way until April 1st of 2024 to take your first year distribution. But note, you'll be taking it out in the year of 2024, and that doesn't excuse the next year's distribution. So we will have two distributions in the year of 2024, and we call that bunching of income. And when we do that, it can push you into a higher tax bracket, maybe cause higher taxation of Social Security, Medicare premiums, and those kind of things. So be careful of this. In most cases, we tell our clients to go ahead and not take advantage of this first year rule and do the distribution, one in 2023, one in 2024. Does that make sense, Pete?
Yes, it does. And,
Okay.
and it also goes to show you what the complexity is.
Yes. They don't make it easy in this area.
No.
Now, more information about the required minimum distributions, I wanted to let you know that once you take your distribution, you can always take more. So if I'll show you the calculation in a minute, and let's say the calculation says you need to take out $5,000. Well, if you decide to take out $10,000, that's fine, but unfortunately, the rules don't provide for any credit for the following year, so you can't carry forward any distributions from one year to the next and to satisfy your required minimum distributions.
Yeah, I find that situation is when I have a client who has long-term care needs at a board and care, and this cost like $10,000 per month. And so taking out more than the required minimum allows us to offset the income tax.
Well, that's right. And I would imagine those expenses, then you may also get a deduction and pushed so that you can itemize. And so it's a great way to use retirement accounts to pay for that.
Yeah.
Yeah. Now, here's some good news. Because of Secure 2.0, they've decreased the penalty. So there used to be a 50%, that's 50% penalty on required minimum distributions. That is to say that if you didn't do this, what you left in there or what was supposed to come out of the account is subject to a 50% penalty. So the good news is that they decreased this penalty to 25%. So still pretty serious, but they even provided a further exception under the Secure 2.0 Act that says that if it's corrected in a quote unquote timely manner for IRA accounts, they'll reduce the penalty only 10%. The bottom line here is that the IRS is pretty serious about you following these rules, and sort of any idea that you might decide to skip this because you've got a great investment, you're probably going to suffer a 25% or in best cases a 10% penalty.
So what happens when somebody has Alzheimer's or gets dementia and, can't understand exactly how much they should withdraw or, handle their retirement account?
Well, that's a great point. And one of the reasons why we encourage people when they do their estate plan to get what we call a durable power of attorney. And I think that was covered in another presentation, but the idea here is that if you're not able to operate an account like a retirement account, then we can have someone step in using the power of attorney to do your required minimum distribution and, quite frankly, save the day. This is probably our number one use for powers of attorney, is coming in for people who are over 73 who might be having a capacity issue to come in and do these distributions to avoid the 25% penalty.
If you're married, can't your wife just or your husband just call up wherever you have your IRA account and guide them through as to what your spouse needs?
The short answer is no. So without the proper legal documentation, these accounts are specifically in individuals' names, and no one else can operate them unless we have a valid power of attorney.
And if we don't have a valid power of attorney, what happens if we need to get in and make a change?
Well, unfortunately, the only option is then to go to court and set up something with is called a conservatorship, i.e. the Britney Spears situation.
Okay, let's move on.
Let me ask a question though before we go on. Somewhat to your statement, Michael, that this is the individuals. The question is, can an RMD be directed to a grandchild's 529? Yes, you take it in and you give it back out. I'm guessing is the answer.
That's right. So the short answer is, not directly. Once you take your required distribution out, you're going to have to record that on your tax return. And then if you decide you want to gift the money to a 529 plan, that's fine to do, but there wouldn't be any relationship to the distribution.
Right. Okay.
So how do we calculate our required minimum distribution, or RMD? And well, the first point is there is good news that most banks, brokerage firms, employers where you have your retirement account will do the calculation for you and start sending you a letter starting at the age of 73. However, I think it's important, and I will show you how to calculate this yourself. Now, all these calculations are done using a IRS table As you'll see in a minute, most of us use what we call the uniform table, and I'll explain all this in just a second. We do have to recalculate this every single year, but again, it's good for you to understand how this works and perhaps double check the bank or the brokerage firm to make sure it's being done properly. Now, this is the required minimum distribution calculation, and as you'll see in a minute, it isn't complex and pretty much everyone can do it. And what we do is we take the prior year balance of your retirement account, and let's say it's someone who turned 73. So we would be taking the December 31st balance of 2022. We get that off the statement and we plug that in the first box. Then we go and get something we call a life expectancy divisor from a table. As I mentioned, most of us use the same table, which I'll show you in a minute, called a uniform table. We find our age, we divide those two numbers together, and that gets us our RMD. So it's actually pretty simple. Let me give you an example. Here's part of the uniform table here, and I've highlighted in red the age of 73. So we'll assume someone's turning 73 in the year 2023. And the divisor that the IRS provides pursuant to this table is 26.5. I'm going to use a hypothetical balance of last year on December 31st of $100,000. And if we divide our IRS divisor into our account balance, it's telling us to withdraw as our RMD, our required minimum distribution, $3,773.58. So pretty straightforward.
I love this slide, Michael.
Thanks.
Because it really kind of shows that it's not, when you look at the divisor number, you probably think, oh gosh, the number is really going to be large, but you put in the withdrawal rate percentage. What does that kind of mean?
Yeah, so what I've done here is I've taken more of the uniform table and I put in our divisor here. But I've added this third column in red to each side. And what it's done is convert that divisor into a percentage, or in other words, what is the IRS really asking us to do in any particular year? So for example, if we look at age of 72 here, we've got, hang on just a second, there we go, spotlight. So if we look at age 73, excuse me, they're only asking you to take out 3.78%. So pretty moderate rate. I'm going to jump all the way here to age 80. It's just under 5% is all the IRS is asking you to take out. So these are pretty generous numbers. In fact, you can imagine in a good year, you might earn more than 5% in a retirement account, and you may end up with a larger balance even after you've taken your required minimum distribution. Now, this table right here is, as I mentioned, somewhat generous. We had a much steeper table years ago back in the early 2000s. And this new table, which I'll talk about in a second, came out just last year. So it's pretty generous. And as you can see, Pete, here, if you make it to age 100, you got 6.4 more years to live.
Yay.
So these numbers are actually what the IRS is anticipating for your life expectancy. And that's how they come up with this divisor number. Now, this life expectancy divisor, as I mentioned, is off this uniform table. There are other tables, but we commonly don't use them. One exception to that might be if you're married and you have a spouse that is greater than 10 years younger than you are, then there is another table to use than the one that we're talking about. And as I mentioned, this table is effective as of the one I'm showing you from January of last year. It's the new table. And the old table, it wasn't a big change from the ones that we had before, but it's important when you do your calculation, there are still a lot of the old tables floating around out there. So watch out. You want to use the table that started in January 1st of 2022. The one that I have provided in my materials here is the updated table. And if you want to get it from the source, you can simply go onto the web and you can get IRS publication 590B. It's you can get it directly from the IRS. There's a publication section and download it. And that has all the tables and also a super good cure for insomnia if you decide to read the 590B.
Not recommended.
Now, if there's more than one IRA, there is kind of a special rule, but unfortunately only applies to IRA accounts. So we can't use this for 401ks and 457s, et cetera. But if there is more than one IRA account, then you can do something special and you can calculate your required minimum distribution for each account separately, and then decide to take the combined distribution from the two accounts out of one account. So let me explain. Let's say you have two IRA accounts and one is invested in some great stocks and you don't want to liquidate any to do your required minimum distribution, but you have a second account that maybe is full of a bunch of cash. Well, again, what you can do here is you can calculate your required minimum distributions for each of the accounts separately, add it together, and then take it out of the one account that has all the cash, the combined distribution, and will satisfy the required minimum distribution for both accounts. So kind of a handy rule if we've got investments that we don't want to disturb.
Michael, if client comes to you and they have a 401k, they have a 403b, they have a regular IRA, they have a SEP IRA, they also have a rollover IRA, can the retirement accounts be simplified? Is that feasible?
Yes. So there are a number of advantages to perhaps combining various retirement accounts into a single account, one of them being simplicity and the number of statements that you're getting. And the rules do allow us to roll over and combine certain types of IRA accounts and other rollover 401ks and so forth. And the only really analysis that needs to be done is that when we look at the difference between an employer retirement account like a 457, a 401k, or a KEO or pension plan versus a regular IRA account, there are theoretically some better creditor protections in our employer accounts. We call them ERISA type accounts. And so if that's not an issue, and we're not worried about creditors, then there's some real advantages to combining them all into one IRA account. And not only do we simplify things, but we may open up a larger investment world for us because we can have a larger choice. A lot of times the employer plans are only one family mutual funds or something like that. So lots of flexibility comes in when we move it to a single retirement account.
Yeah, and as you get older, you want, simple is better because you stay in control. And if you have 5 different statements coming in and all different types of IRAs coming in, tax issues are going to be more difficult. Keep it simple, stupid. It's really important.
So the next lifetime rule I want to talk about is something we call the qualified charitable distribution rule. Sometimes we call this the QCD. In essence, what it says is that you can take money directly from your IRA account and gift it to a charity, and then the income from that distribution gets excluded from your tax return. Now, this QCD or qualified charitable distribution rule has a sort of challenging history. It was in place for a while, and then it ended, and then it got put back in retroactively and all kinds of crazy things, but they did make it permanent part of the code. As much as our tax code is permanent, it is there for us to take advantage of. And in fact, even more consideration under the current tax laws that we should look at this strategy as a way to come out with an effective tax plan. So the best way for all of us to understand the qualified charitable distribution rule is to understand how it worked without the rule. And the way that it worked without the rule is what you would do is withdraw money, for example, from your IRA account, probably put it in your bank account, and then write a check to a charity of your choice. Now, when you did that, you had to record the distribution from your IRA account onto your tax return in something we call your AGI, or adjusted gross income. And then the hope, of course, was that since you made a offsetting charitable contribution, that the charitable contribution and the income would offset each other. But unfortunately, that always wasn't the case. or isn't the case. And the reason is that a lot of taxpayers don't itemize. And remember, when we don't itemize, we don't have our individual charitable deductions to take off. We just take what's called the standard deduction. And in fact, under the current tax law, they have increased the standard deduction so high that many of us don't itemize anymore. So what would happen is you'd have the income on your tax return, but no offsetting charitable deduction. So that was a problem before we had the QCD. But other than that, even if we got our charitable deduction, there were still other problems. Because this was included in our AGI, it may increase the taxability of our Social Security and Medicare premiums and other deductions that were tied to AGI. So it didn't work out very well. So the qualified charitable distribution rule sort of came to the rescue to cure this problem. And the way that it works is that if we do it as a qualified charitable distribution, again, direct to the charity, the distribution is excluded from your income, and all the problems I just described don't matter anymore because they're cured by this rule. And as sort of a kicker to all this, even though the income is not taxed on your tax return, it's excluded, it still satisfies your required minimum distribution. So think about that. It's quite amazing. So if, for example, you write a check of $1,000 to Chapman University every year to help with scholarships out of your bank account, well, what about if we do it this way? What if you had your IRA send a check to Chapman University? You wouldn't have to include the $1,000 on your income, and your required minimum distribution would be satisfied or partially satisfied using this rule. Okay, so a really worthwhile endeavor for you to consider.
It's almost now is that if you are charitable minded and you are 73 and have an IRA account, this is absolutely the way to go. You'd have to have a reason not to do this.
That's right. Well, let's talk about the rules and how you actually would do this. There are some rules. You can't do more than $100,000 in any particular year, again, distributing money to a charity. Now, the good news is under Secure 2.0, they index that $100,000 to inflation starting next year. So that $100,000 number is going to be going up every year, but you certainly don't have to do $100,000. You can do 100, you can do 1,000. There is no minimum. You just have to do it through the proper channel. Now, you can start doing this at the age of 70 and a half. We think that this is probably a mistake and an oversight. So even though you don't have required minimum distributions yet until 73, you can do this at 70 and a half or older. We do have to make the distribution direct to the charity. Now, that doesn't mean that they can't make the check out, Schwab or Bank of America or Merrill Lynch to a charity and you can walk it over there, but it does have to go direct, and meaning made out to the charity. And one of the issues that's come up with this is that if your brokerage firm or your bank mails the check to a charity, it usually doesn't have a name on it. Nobody knows where it comes from. So you may want to alert the charity if the institution that holds your retirement account is mailing it direct, and let them know that it's coming.
Yeah, and you can even ask the brokerage firm to mail you the check. And then so long as it's made payable to the charity, and you can deliver it or mail it to the charitable organization.
And I always tell people that you should have it mailed to you because, one, you're going to make a photocopy of it so that you have a record that this money went directly to the charity, and then you put a note with it, and then you mail it directly to the charity, but you don't have your investment firm do it.
That's the CPA God speaking.
Yes.
All right, and the
Absolutely.
last point on this slide is something also interesting that was added by the Secure Act 2.0, and that is that we can now do what we call split interest gifts with qualified charitable distributions. So, for example, you could put money into a charitable remainder trust, or more commonly, maybe open up a charitable gift annuity. Now there's a lifetime limit of $50,000, but in an example, what you could do is you could have $50,000 sent to Chapman as a qualified charitable distribution, but have set up with Chapman or another charity that you want it to be a gift annuity. And that money goes into this gift annuity, and then you get a stream of income for the rest of your life, and the charity gets the remainder. So an interesting charitable opportunity here under the QCD rules.
Brand new.
Brand new.
Brand new. So some tires may not be completely familiar with it. So make sure that you call up the institution where you wanted to make the gift, and they can help you through it as well.
And next week, when I do the charitable opportunities session, I will discuss this again. So I will remind all of us of that.
Okay, sounds good.
Now, a couple of other items about Secure 2.0. This is again the act that just came out a few months ago.
Yeah, Michael,
And-
do you know why they call it a secure act? Is there any rationale by that?
Yes, there is a very long set of words that they forced into the word secure.
Oh,
I don't
really?
remember what it is, but each letter stands for something.
For something. Okay, it's not just to secure as far as the definition of the word.
That's right.
Okay.
So there's lots of other provisions in this Secure Act and the Secure 2.0, and most of them really focus on providing incentives to promote retirement savings and expand the flexibility. So a lot of that stuff is positive, and we're not going to cover all that. But I thought it would be interesting to talk about some things that weren't in Secure 2.0. And the first is, some of you may have heard of something called a backdoor Roth, where you sort of skirt the rules to fund a Roth account.
Okay, I got to stop you for a minute. So Pete, the answer to your question, because Lindsay just answered it, setting every community up for retirement enhancement.
Setting every
Community
up.
for retirement enhancement.
Oh, wow. I'm going to stick to secure.
Good idea.
I'm sorry to interrupt you, Michael.
That's okay. Now you know why I don't know what the acronym stands for. So the Secure 2.0 didn't limit, there was some expectation that it might, but didn't limit the backdoor Roth conversion. So that's still available. And you may have heard there was I think his name is Peter Thiel, who created PayPal. He used these rules to get $5 billion, and that's not million, $5 billion into a Roth account. And there was some discussion about, trying to punish large retirement account holders, but that was not in Secure 2.0 either. And the last thing that wasn't in there was some clarification regarding the confusion about how we treat the required minimum distributions after you pass away for our beneficiaries, which I'll talk about in a minute, and you'll see what the confusion is. But that was not in Secure 2.0 either, so we're still stuck with the confusion.
Yeah, and I'm amazed that the Roth IRA is still around. So, and we're going to discuss that after a little bit.
Okay. Well, so that's the discussion regarding how these accounts are treated during a lifetime. The next part of my presentation is how we choose beneficiaries for these retirement accounts and how they're treated after death. And I know all of you are at home likely, so this is the time where you might want to turn on the espresso machine and take a shot of coffee. The IRS doesn't make it easy in these rules, as Peter mentioned. They are complex, but I'm going to try to break them down as simple as possible. And in fact, I'm going to start with 5 concepts. I think if we all understand these 5 concepts, then you'll have the understanding to better understanding of how the rules work. So the first concept is that during life, you get to pick beneficiaries for these retirement accounts by completing something
This is the first time that Pete has actually left to turn on the espresso machine.
You might be in there, right?
Yes.
Anyway, these are, you fill out these beneficiary designation forms at the institution that holds your retirement account. So that could be your bank, your brokerage firm, your employer. They all have these forms. Now, the good news is when you complete one of these beneficiary designation forms for your retirement account, it is what we call a contract to pay on death, and it avoids probate. So that's the first advantage of filling out the form. The second is you can change these forms anytime you want to. There used to be some old rules that said there were limitations on when you could change them, and that's not the case anymore. You can change them anytime you want, just the latest dated one that has been received and recorded at your the institution that holds your retirement account is the one that will control. And this third subpoint here, and I can't emphasize this enough, it is these beneficiary designations that control the retirement accounts, not necessarily your will or your trust. What do I mean by that? Is that you could have a will or a trust that leaves everything to, say, your children, but you could fill out a beneficiary designation form that says, I leave everything in my IRA to my neighbor, and your beneficiary designation will supersede your will and your trust. So by doing your will and your trust, you are not necessarily taking care of your beneficiary designations, and you need to do them separately. And that's why it's so important we pay attention to these things. Now, the second concept is that after death, our designated beneficiary, again, the one that is named on this form, can continue to some extent defer the income on the money inside of your retirement account until it is withdrawn. And this is really important. The third concept is the IRS still wants their share, and they're going to require the beneficiary to start withdrawing money from your retirement account for the purpose of the IRS collecting a share of that money.
Before you go on, I'll ask the question that I've been stalling answering until you got to about here. What if you're giving your entire estate to charity? Is it still taxable?
So we're going to get to that, but the short answer is that one of the ways that we're going to beat the IRS at the game is by using charity as a beneficiary for your retirement account. And in that way, we will not have to pay taxes.
I figured if Pete wasn't here, I should ask that question. Thank you.
Okay. Now, the fourth concept is that from a tax standpoint, it's likely preferred that your beneficiary avoid taking a lump sum distribution from these retirement accounts. And a lump sum meaning taking it all out in one lump sum and not deferring it over a number of years. And the reason we don't want to do that, or we don't want our beneficiaries to do that, is that we lose the future tax deferral of having the money sit in these accounts. But we may likely be pushed into a higher tax bracket because all the income comes out in one single year. So the fifth concept is that generally the strategy is then to try to make the beneficiary's withdrawal period as long as possible. And before the Secure Act, we could do something we called stretching your retirement account. And we could literally take a retirement account after you've passed away and create decades upon decades of tax deferred growth for our beneficiaries. But unfortunately, because of the Secure Act, they put a kibosh on that kind of planning. And starting in 2020, they have eliminated that possibility. And although there are some exceptions we'll talk about, the Secure Act generally requires that all retirement accounts, including Roth IRA accounts, be emptied after 10 years after you have passed away as the account holder of the retirement account. Now, where the confusion comes in, everyone's pretty clear that everyone basically has 10 years with some exception. But to the surprise of everyone, there was sort of an understanding that you could do anything you wanted during that 10-year period to empty the account. But in the new regulations, that 275 pages of regulations, the IRS seemed to indicate that if our account holder, you guys who pass away, were over the age of 73 right now and taking a required minimum distribution, then our beneficiaries would have to take a little bit, a required minimum distribution every single year during those 10 years. If you were not taking a required minimum distributions, you could do anything you wanted during the 10-year period. So all of this provided quite a bit of confusion. The understanding right now is that if someone is taking the required minimum distribution and you during your 10 years, then you have to take a required minimum distribution on your own life expectancy. So you can see how incredibly confusing they have made this. Now, keeping in mind that we generally have this 10-year cap on retirement accounts, there are some exceptions. We call them EDBs, eligible designated beneficiaries. It's a special level of beneficiary that are exempted from this 10-year rule. And those people include surviving spouses, minor children, disabled or chronically ill individuals that are going to be beneficiaries of a retirement account. Or if you pick someone as a beneficiary who's not more than 10 years younger, the good news is you get to escape the 10-year rule.
It's not easy.
Not easy. So as you can see, this is a somewhat complex area, and the rules for these distributions really are contingent on who you pick as beneficiaries. And with this in mind, it's important, excuse me, to spend some time thinking about who's going to be the beneficiaries of these retirement accounts. Excuse me. Now, I've kind of broken this down into 5 categories of potential beneficiaries that you could write in on your beneficiary designation form. 1 is spouses, 2 are children, grandchildren, and other adults. We could also name a trust as a beneficiary. And as Dawn mentioned, we could also name a charity as a beneficiary, or perhaps we do a combination of all of these categories in some cases. Now, the first category I want to go over, and again, picking beneficiaries for our beneficiary designation form, is the possibility of naming a spouse. For those of us who are married, we can name our spouse as the primary beneficiary, and there are a number of important benefits. One is that our spouse can have immediate access to our retirement account. We get to escape the 10-year rule or limitation under the Secure Act, as I just mentioned. And spouses also have a special rule that is only available to spouses called the spousal rollover rule. And I want to show you briefly how that works and why it's important. I'll give this an example here. If we have an IRA account and you pass away, but you've named your spouse as a beneficiary on your retirement account, your spouse can open up a brand new IRA and move all of your IRA assets into their new IRA. And because it's a new IRA and it's a spousal rollover, the spouse is treated as this IRA as their own account. So for example, if they're not age 73, they don't have to take required minimum distributions. Even if you had to, it doesn't matter anymore. This is a new account. They can name new younger beneficiaries for beneficiaries on the account. And importantly, the Supreme Court said that if you do this spousal rollover, the spouse can get some extra creditor protection not available in other situations. So a lot of clients take advantage of this spousal rollover rule.
How does that work with second and third marriages?
That's right. In fact, that's what this slide is about, is that naming a spouse as a primary beneficiary may not work in all situations. Remember, the spouse does have full control of the money. If we're worried about how they might spend it or what they might do with it, that's a problem. And as you just mentioned, Pete, maybe this isn't the right solution for a blended family. If we're trying to get money down to children of a surviving deceased spouse, this may not be the best solution either.
Yeah, it takes some thought, especially if you're in a second or third marriage.
That's right. So our second category of naming beneficiaries are possibly naming children, grandchildren, or other adult beneficiaries. Now, if we're naming children, minor beneficiaries are exempted from the 10-year rule, as I mentioned. But by the way, that's only 10 years. They are exempted only until they reach age 21, which is what the IRS now calls the age of majority. And then they get 10 years. So it's not exactly a panacea, but in any case, we don't really want to name minor beneficiaries as outright beneficiaries of our retirement account. I know many people do this with the best intentions, but remember, a minor doesn't have a signature. And if we leave money to someone who doesn't have a signature because they are not old enough, then we have to open up something we call a guardianship with the court. It's a very complex situation. So as you'll see in a few minutes, we'll review again. This is a mistake. We don't want to name minor beneficiaries as outright beneficiaries.
In California, when does a minor have the power of a signature?
The power of the signature is 18 in California, not to be confused with age 21 under the Secure Act, which is a different set of tax rules.
Okay.
Now we can name adult children. And if we do that, we can have up to 10 years for that adult child to remove money from the account. That does provide many years, a decade worth of tax deferred growth. The child might be able to, quote unquote, manage their tax brackets during that 10-year period. And maybe there's periods of time where we have low income, the child does. So we take more out of the retirement account during that 10-year period to try to end up with an effective tax rate throughout the 10-year period. So there are things that can be done to manage the tax brackets during the withdrawal period. Having said that, this is one of Pete's favorite topics. If we do name a child as an outright beneficiary or other adult or grandchildren, there can be problems. As I've mentioned, it's a problem clearly to name a minor child, but we might have the child, even though you have this best intentions for them to stretch it over 10 years, they'll just simply do a lump sum distribution. It is amazing how many kitchens need to be remodeled only 10 days after your death, or a brand new Porsche needs to be purchased. So we can have irresponsible spending. And if the children have creditors, if they take it all out, they may be able to, the creditors of the child might get to your retirement account.
Yeah,
Peter,
Michael,
you want to comment on this?
Yeah, when I see is that even adult children, I mean, talking to adult 50, 60 years old, you parents die and leave their IRA account. Let's say it's in September, they don't understand. Well, first of all, how long after a person's death can an adult child access this money?
Well, that's a really important point, because to get to these retirement accounts, all the child needs, if they're named as the beneficiary, is your death certificate, which here in Orange County takes somewhere between 5 and 10 days to get. So oftentimes, this may be the first money that becomes available to a child.
Yeah. And so if they withdraw this money from the IRA account, what they don't understand or realize a lot of time, the impact that it has on their income taxes. And so they withdraw the monies, and usually there's a clerk there who doesn't understand either. And they withdraw the money, and then coming the following April, they find out what the tax hit is. But by that time, the cat is already out of the bag. It's too late to put it back in, and they're hit with an enormous income tax issue the following year. So you may, if you have a large IRA, you may want to talk to them about the advantage of that 10-year stretch, because that's still a huge benefit to your adult children.
That's right. And although to add to what Pete is saying, remember, this additional income, if they did a lump sum distribution, may push them into a higher tax bracket, because remember, not only do we count all of this income, but we have to add that on top of their own income, and maybe that child has a job. So the taxation can, we can get up to 50% on this, and that's kind of a waste.
Yeah, especially, we add California tax on that as well.
For sure. Now, the third option for us to consider is possibly naming a trust as a beneficiary on our retirement accounts. And the IRS does allow this. The trust must meet certain IRS requirements and include special provisions regarding retirement accounts. Excuse me. And this is particularly true under the Secure Act, because the bulk of the Secure Act, the first one, and the regulations focus on how we deal with trusts. And it's sort of complex. Now, there are benefits to naming the trust that come along with some complexity. But if you're saying, oh, I want to control things and all the things that we're talking about, we can provide the missing control by naming as trust as a beneficiary, because the IRA or retirement account gets to be owned by the trust, and we have another person, a trustee, in charge of that, protecting the assets. Now, doing this, we can protect the assets from a conservatorship or a guardianship. The trustee of the trust can mitigate irresponsible spending. We can protect against creditors. And the Secure Act says that if it's done properly, we can take advantage of some of the exceptions if it's set up for a surviving spouse, a minor child, again, chronically ill and disabled individuals, or individuals not more than 10 years younger. So we can do this. Now, there are disadvantages to naming a trust, and Natalie Choate, who's sort of our national authority on retirement account planning, she's a attorney out of Boston who's become very famous in her writings and so forth, says you better have a compelling reason to do this, because there are some complexities and some disadvantages, and maybe there is a compelling reason, maybe it needs to be done. But here are some of the negatives. The first is that there is no spousal rollover available because a trust is not your spouse. The trust has to be very carefully drafted under the Secure Act to make sure it applies and we can take advantage of the Secure Act and the exceptions. It is possible, if the money is not distributed out of the trust to the beneficiary, that we could end up paying a higher combined tax rate on the retirement accounts, because unfortunately trusts, they don't pay higher taxes, but they get to the highest tax rate at only $13,000 worth of income. So we have to watch out for this. This can be very administratively complex, and walking into Merrill Lynch, Charles Schwab, or Bank of America and telling them that you are the trustee of a trust who's going to own a retirement account, you're going to get a head spin from the clerk who's there. Yeah. And quite frankly, this can be very expensive planning. So again, if we have compelling reasons to do it, then it fits the bill.
Yeah, the most attorneys will, if you go into this situation, will charge somewhere between $3,000 to $5,000 per trust for an IRA. And then most of them have to look in the book to figure out how to draft that trust appropriately. So you better have an attorney who does this on a regular basis. And Michael is absolutely correct. It's expensive, administratively complex. You have to have a really good reason to do this. If you do have a trust, and what you may want to do is use the trust as a pass-through. In other words, the assets go into the trust and get it to the beneficiaries before the year is out, so that the bulk of the monies do not stay in that trust, because when money comes out of an IRA account, it comes out as all of it comes out as ordinary income. Do some tax planning if you have a trust as a beneficiary.
Michael, before you go on to 4, I want to take you back to 2, although you don't need to change the slides. Question is, and it's come up in other discussions before, can an adult grandchild request a death certificate in Orange County?
I don't know the answer
I know,
offhand.
you're an attorney. The answer is it depends. I'm sorry.
Well, so here's the way that it works is a few years ago, maybe more than a few years ago, they created a system so a stranger couldn't go and ask for a death certificate.
Right.
And you have to make a statement about what your relationship is, or whether you're an attorney who's representing the decedent, et cetera. And you have to have that statement notarized. Offhand, I don't think a grandchild can do it. A child can, an attorney can, a spouse can, and
fiduciary can.
What's that?
Fiduciary can.
Fiduciary can. So, and although I don't have access to it, if we jump on the Orange County Recorder's website, that's where we get death certificates. The application will list the degrees of relationship of who can ask for a death certificate, but I don't know the answer about grandchildren offhand.
Because I know there's been a question about adopted children, about, first married children, whatever else that are all.
Most likely, yes, is the answer, but not guaranteed. It also depends on who I do this often to get a death certificate. It depends on the teller. And if you're somehow related, you just swear that you are related. So they're trying to prevent strangers from getting a death certificate.
Yeah. Okay, thank you.
Now, the fourth option, and the one that Dawn had mentioned earlier, which is a really interesting option because we've been talking about how we're going to pay all these taxes. Well, here's one way that we can avoid paying the taxes, and that is using or naming a charity as a beneficiary of a retirement account. Remember, charities don't pay any income taxes, and by doing this, you could also potentially reduce your estate taxes if we have a very large estate. But think about this for a second. Most of our clients get this reversed, and I'm going to call the money inside of your retirement account the bad money because it has not been taxed. And the money inside of your trust, I'm going to call that the good money. But what clients do is they reverse this. They name the charity as a beneficiary under their trust and give them the good money. And they name their children as beneficiaries under their IRA or retirement account, and they give them the bad money. We want to swap that because, again, as this slide is demonstrating, if we do that, the charity doesn't have to pay any income taxes and the children get more of the good money.
Yeah, and you can also, we're going to talk more about this next week, but you can also give your kids a stream of income through a charitable gift annuity and a charitable remainder trust from your IRA account. So it's a little bit more complex, but that's feasible as well.
Now, the last option really is just perhaps understanding that we don't have to make one choice. You could have a large IRA with multiple different beneficiaries. You could take a large IRA and break it up into different IRAs with different beneficiaries. So there's lots of flexibility and unfortunately not one straight answer for every individual. It does take some analysis and some consideration. Now, with the Secure Act, and as I've explained, are basically most of us being subject to this 10-year rule if we're going to be a beneficiary, how can we respond to this and what, quite frankly, is going to be a lot of taxes for our beneficiaries? So here's some ideas. One is, as I've already mentioned, we can simply just accept the taxes and do our best to manage the tax brackets. Again, we're talking about your children, your beneficiaries, taking steps to try to have a lower tax bracket during certain years and try our best to manage the tax bracket during that 10-year period. As Peter mentioned, we might look at, and which we'll talk about in the next presentation next week, is charitable remainder trust is a possibility. I have some clients who have contemplated buying extra life insurance so there's more money to pay the taxes. That's a possibility. We can talk about doing Roth conversions, and we're going to talk about that at the end. Possibly converting some of this money into tax-free money is a possibility. As we just said, we can certainly name charities as beneficiary and make sure we're taking advantage of our lifetime QCDs and also maybe charitable gift annuities as a way to deal with the Secure Act, again, using this money for charitable purposes. And most importantly, why don't you just spend it? That's the best way.
What a concept. That is just an amazing concept that you can spend your IRA money during your lifetime. Highly encourage it, by the way. One of the things that I wanted to ask you is that on the beneficiary designation form, are you going to talk a little bit about that? Okay,
yeah.
Great.
Yeah, and I guess the last concept here is that, and you and I have talked about this, Peter, I have clients whose sole purpose in life is not to touch their retirement account and to make it as large as possible. And perhaps this idea, the old idea that our beneficiaries are going to get able to keep this for the rest of their lives as their retirement. And that's really not the case anymore. Most of us are going to be subject to this 10-year rule, and we do have to have a different mindset now. Now, this next slide are mistakes we've seen come through our practice. I'm going to briefly run through these, but this is a really important slide because I don't want you guys to make these same mistakes.
Yep.
So in filling out this beneficiary designation form, you're giving an opportunity to, again, designate beneficiaries, but many people leave it blank. I've had that case, right? And when we leave it blank, if the amount is large enough, it means we have to go to court, we have to go to probate.
Or they name individuals that are older than they are.
That's right.
And
or you see in my second example, naming my estate.
Oh, I see this so often.
And unfortunately, that doesn't have any legal significance, and we're back in probate court. We've already discussed naming minor beneficiaries. I understand it's the best intent to name our 3-year-old grandchild as a beneficiary, but it ends up to be quite a problem if it comes to fruition. Now, in these beneficiary designation forms, there is a section where you can write your primary beneficiaries and a section where you can write your secondary, or what we call contingent beneficiaries. And many people don't fill out both sides. And unfortunately, we do have to make sure that we have a backup plan. Unfortunately, life doesn't go always as planned. But if we do this properly, we can do something we also call post-mortem estate planning. Perhaps there's a reason our primary beneficiary doesn't need or want the money, and maybe we want to bypass them and get it down to our contingent beneficiaries. That kind of planning can occur, but only if we've done both primary and contingent beneficiaries.
Can you put on your beneficiary designation, I want to give 10% to this beneficiary. I want to give 50% to this beneficiary. Can you alter that, or does it have to be all equal?
No, it does not need to be equal. As I mentioned, we could have 10% to one child, 10% to another child, 80% to a charity. You can break it up any way you want.
Okay.
Now, another issue we have is not keeping beneficiary designations up to date. I certainly have had new clients come in and they've got their spouse from 3 marriages ago named as their primary beneficiary. So we want to make sure that our beneficiary designations are up to date and that we have a current record of what beneficiary designations on file. With all the changes in the banks and the brokerage firms and the mergers, these forms have been lost. I've had that case before. And so what we encourage our clients to do is to make sure when they submit their beneficiary form that they get a written confirmation. And if you've already got it on file, just call your bank, your brokerage firm, tell them you want the letter, and they'll generate one for you.
And one quick one is that if one of the spouses is older than another one, is the issue there is to make sure that there's a contingent beneficiary named?
For sure. In that situation, we want to make sure that we've got a backup there, or we could have another problem. And the last point here, and we've already sort of beaten this dead horse here, is that we want to make sure we're giving consideration to these forms, the income taxes, and selecting beneficiaries. So don't make the mistake of not paying attention to this.
Yeah, income in IRD is, we didn't talk about it much, but income in respect of the decedent is probably the tax that's going to hit.
Which we will talk about next week.
Okay, we will, but I just want to IRD.
In the interest of time.
We got another, how much time do we have, Don?
7 minutes.
7 minutes, okay.
All right. Well, we're getting close to the end here. And as I mentioned, I saved the Roth IRAs to the end. So they do have a different set of rules. So we've been talking about these RMDs that are required for everybody who owns a retirement account. But guess what? Roth IRAs don't have any RMDs during your lifetime. So we don't have to worry about the calculation. Now we can continue to make contributions to these Roth IRAs as long as you have earned income. And here's the key, the third point here. The money in these Roth IRAs is growing tax-free. It's not tax-deferred, it's tax-free. That means tax-free distributions to you and your beneficiaries later in life. Now, there's still a 10-year rule that your beneficiary has to empty the Roth in 10 years, but it's still not taxable. And we can still do a spousal rollover is available for these Roth IRAs. So a really neat deal. As you mentioned, Pete, it's always amazing to see that they let this go through and that it's still in existence.
Yeah, exactly.
So you may be saying to yourself, I don't want my junky old regular retirement account. I want a Roth account. Can't I convert it? And the answer is yes, but it's not as simple as it might seem. So we can convert traditional IRAs and other retirement accounts into Roth IRAs. Everyone is eligible to do this. There used to be some income limitations that you couldn't have a certain amount of income, but that's been eliminated. But here's the key. You got to pay the income tax on the conversion. So careful analysis needs to be done to see if this really makes sense, because it is not cheap to convert it from a regular account into a regular retirement account into a Roth. Now, one quick note is that you used to have the ability to reconsider your decision. We called it a recharacterization, where if you didn't like the results after you converted into a Roth, you could go back, but they stopped that. So once you make this choice, it's irrevocable and you are stuck in the situation. So what would we think about if we're going to try to do Roth conversions? Well, one factor might be that you expect your income to be higher in retirement. If that's the case, then maybe you want to do conversions now at what might be an effectively lower tax rate. Another factor to consider is that you're not going to need this money for living expenses. What I mean by that is we want to make sure the money stays in this tax-free environment, growing tax-free, so we can take advantage of it. And that's the same with the investment horizon. We don't want to convert this if the money can't sit and grow in this tax-free retirement. So we've got to run the numbers on this. this fourth point is really the most important point, is that you've got to be able to pay the taxes from a different account. And what I mean by that is we want to use separate funds. And an example, we're going to take $100,000 out of our regular IRA account and convert it to a Roth. We want the full $100,000 to end up in the Roth account. We don't want, for example, if we owe $30,000 for the taxes, to take it out of the money and only end up with $70,000 in my example in the Roth account. So what we want to do is put the full $100,000 in there and then get $30,000 out of your bank account, your brokerage account, or some other taxable account to pay the taxes. That's the only way these numbers work. There are also some estate planning objectives that can be covered by doing a Roth conversion. The bottom line is serious analysis needs to be done to whether this makes sense. CPAs, as well as financial advisors and some attorneys, can help you with this decision.
Yes, and it's individual. So it's not a broad brush that it's good for everybody. And you have to look at it, and especially what are you trying to accomplish? And you need somebody to run the numbers. Nobody can tell you off the top of their head that this is good for you or not good for you.
All right, and this is my last slide, basically, and I just wanted to throw in here the possibility of maybe jumpstarting a children's or grandchild's retirement fund by using a Roth IRA. So if a child or grandchild works at, I don't know, Jersey Mike's or something, and they have their own earned income, it doesn't have to be that income. They just have to have earned income of up to $6,000. You can take that same $6,000, put it into a Roth IRA. They're going to enjoy all of the tax-free growth for their lifetime, can create an amazing nest egg for them of all this tax-free money. You can even, as you can see in the fifth point here under Secure 2.0, there's even some ability now to convert unused funds in a 529 plan into a Roth account. So some really neat stuff here to jumpstart our children's retirement. But do keep in mind that once they turn 18, they do have control of this, and their best laid plans can go awry. So with that, today we've covered a lot, but we focused on our retirement accounts and how these is just one section of a good estate plan, but hopefully you better understand how it fits together to make one successful estate plan. And with that, we've got a minute or two. I'm happy to answer any questions.
Michael, great.
It's amazing. He's never done this before either. Yes.
Really, I mean, it's a complex area. And thank you for doing such a great job in explaining this. Why don't we go ahead?
Michael, why don't you stop sharing?
Yeah.
Thank you.
And
Okay, so what I'm going to do is so we have no open questions sitting here. I'm going to say thank you very, very much. This has been Financial Estate Literacy. It's your estate. We've been talking about retirement accounts, and I thank you very much. And I'm going to turn off the recording.